Good
Hey,
afternoon, everybody.
hey, good afternoon.
Part
Happy
two of
Friday.
the webinar series. Balance sheet. We're going to get started in a couple minutes here. Wait until people filter in. And we did a similar thing if you were here for part one of the profit and loss overview. If you can please just in the chat, just let us know, grade yourself on how well you know the balance sheet. One being that you don't really have too much of a good grasp of it, and then 10 being you're expert. Would love to kind of see where everybody's at here. Aloha from Hawaii.
Oh, I'm jealous.
Melissa. That's pretty cool.
Although the weather's supposed to get warmer this weekend in New York, which is where Joe and I are at.
Long Island, New York. All right. All right, seeing a lot of different numbers here. The balance sheet is not the most straightforward financial statement to understand, and that's why we wanted to dedicate a whole webinar to it, along with the other financial statements. So I hope for those of you that are mentioning some of those low numbers, that we can get those up, even for those that have those higher numbers, giving you some perspective into some of the different balance sheets that we're going to look at today as well. So right. All right, so we'll go ahead and kick things off. I know it's a Friday, so we don't want to keep everyone from their weekend festivities here. For those that don't know us, so we're the co-founders of Cycle CPA. We're a remote accounting firm that provides services specifically to green industry companies, and our team works fully remote, and everything from really that bookkeeping perspective all the way to the tax side as well. And really looking forward to today. I think the balance sheet, like I said, I think it's one of those financial statements that is incredibly beneficial to be able to understand. It gives you a really good picture of just the financial health of the company. But I think a lot of people are a little bit, not as confident when it comes to reading it. So really looking forward to diving in here today.
Yeah, no, I'm super excited for this too. I love, analyzing balance sheet numbers because I think it tells you a good indication of the financial health of the business today, but it also tells you a lot about what to expect in the future. So for me to analyze something like that, it really helps me communicate to the business owner what the priorities are. And it gives us a lot of that insight in the financial health of your business. So today, that's what we want to clear up, so that way you can analyze your own balance sheet and have a good idea of what a balance sheet entails as a business owner. And don't feel bad if you're not as up to speed on the balance sheet. There are a lot of accountants that I know that have a hard time analyzing the balance sheet as well. So we don't expect you to be experts, but please ask questions along the way, because we want to make sure you guys have a good understanding of the balance sheet. But just starting off, I'm going to dissect the three elements of a balance sheet. So a balance sheet consists of assets, which is what your company owns, liabilities, which is what your company owes to others, and equity, which is what you own in the business. And you can see here, there's an equation in accounting: assets equals liabilities and equity. And these two sides of the equations must balance for everything to make sense on the financial statements. So the balance sheet is giving you a financial look of the company at a point in time. So it's an aggregate of numbers that add up since the beginning of your business. So this is different from the profit and loss, where you can kind of look at it at a period in time. So if we're looking at January through March of 2024, 2025, I mean, you kind of get that segment of numbers. But the balance sheet, it's different in that way, that it's an aggregate. So that's different. And again, it helps you take a pulse on the financial position of your company. And we'll dig into a little bit more about that, because it tells you a lot of cool things that you need to know as a business owner to make decisions about your company. So I want to get into that part, because I think that's the most interesting, is analyzing. And the starting point is cash balance, and the ending point in the balance sheet is a retained earnings. And I'm going to take you through all of those different groups on the balance sheet.
And a good way, another way to look at the balance sheet, just as a basic understanding, is almost think of your house, right? Where the value of the home is the asset, and the down payment that you put down is the equity, and the liability is your mortgage, right? So it's a similar way that you can look at your business, and even in regard to utilizing leverage and just the balance sheet in general, when it comes to your business.
And remember that equation that we spoke about down here, liabilities plus equity, equals the assets. And I can't write on here. But anyways, what I'm trying to portray is like here is the asset, right? And here's the assets, and here's the liability, which is the mortgage part of that, and then your down payment, right? So this part makes up this side of the equation, liabilities plus equity, and then the asset, the entire value equals up the other side of the liability, which is assets. So just a visual representation there that Joe put together, and I thought that was cool. Okay, great. So here is a condensed version of a balance sheet. So I thought I would start it out simple, so we can just break it down little by little. So this is as of March 31st, 2022, right? And it starts off with the asset section. So current assets, and we'll dive a little bit deeper into that, which are, what are current assets? Those are items that are helping your business or benefiting your business in the short term. So something like that could be your checking account balance, the cash in your bank, accounts receivable. Those are short-term items that your company is benefiting from, right? And then we got fixed assets here. And those are long-term things that your company is benefiting from. So, for example, a skid steer or a truck. Total current liabilities. So we'll come down to the liability section. Remember, this is what you owe to others. So on the flip side of that, we just went over assets, what your company owns and what your company is benefiting from. And then on the other side of the coin is like what your company owes to others. So current liabilities is what your company owes to others in the short term. So in the next, 6 months to a year, your company may owe credit card balances, right? You may owe sales tax payments. So all of those items. Then you have long-term liabilities, things that your company owes to others over more than a year. So you may have like a 5-year loan through Sheffield or Ford, and that would be reflected here. And then the equity section, that's what you own in the business, right? And that's super important.
And Carl, we have a question. So Darren asks, when equipment is fully depreciated, it's not an asset, correct? At least on the balance sheet until it is sold?
So if an equipment is fully depreciated, it's still an asset. So it would be an asset for, let's say, $5,000. But if it's fully depreciated, the accumulated depreciation, and I can show you this in the next balance sheet, the negative amount, the 5,000 will wash out that 5,000. So if it's 5,000 positive, there's going to be a negative 5,000, and then that equals 0. So it never comes off. Like, you'll always see it on there, but that negative accumulated depreciation negates it so that it's a 0 wash.
And what is accumulated depreciation?
Accumulated depreciation is depreciation that is taken every year. So let's say for that $5,000 truck, just to make like easy numbers here. Let's say that you had a $5,000 truck and you depreciated it over a 5-year period. Then you were depreciated $1,000 every single year. Year 1, you would have $1,000. Year 2, in the accumulated depreciation account, you would have $2,000 because now you accumulated depreciation for 2 years. So that's how you can think about it. Like, it's just a running total. Remember, I told you that the balance sheet is like an accumulated or an aggregate amount. Okay. So, like I said, assets are resources with economic value that your business owner controls, that the company can benefit from. So current assets are things that your company is benefiting from in the short term, in the next year. So your cash, right? Your checking account, savings account balances, accounts receivable, what you're waiting for your clients to pay you on, right? Accounts receivable means that you rendered the services for your clients and now they owe you this money. So that's why it's a resource that your company can pull from, right? In the short term, it's going to be converted to cash. Inventory, seldom companies in this industry do have inventory, but if you do have irrigation supplies or something, inventory on hand, or even some of the install companies I know have some inventory, it's part of your current assets until you use it and expense it. So then that moves over to the profit and loss, because in essence, it's saying that you're going to be able to, it's a resource that your company can use in the future. And then prepaid expenses as well. So let's say that you prepaid your insurance for half of the year, which I know many of you do. Like, you have this big insurance payment at the beginning of the year, and then that gets expensed every month during the year. And then non-current assets, so your fixed assets that your company is able to benefit from over the year, like over that 1 year mark. So your equipment, your trucks, your buildings, vehicles, you're not just going to use that in the next year. You're going to use it for multiple years down the line. So that's why it's called fixed assets. All right. So liabilities, this is what your company owes to other people. And so the current liabilities, like I said, those are things that you owe in the short term. So accounts payable. Maybe you have like a line of credit with a trade credit set up with SiteOne. I know a lot of you do. That would be under current liabilities because SiteOne is going to lend you credit to buy materials, but in the next 30 days, that's due. So that would be current liabilities because they're not giving you more than 1 year to pay them. They're giving you 30 days to pay them. So that would be a current liability. Some payroll items would be current liability, credit cards, stuff like that. And then you also have long-term liability. So you may owe like a Sheffield loan, right? And they may give you 5 years to pay that off. That would be under your long-term liabilities. All right, the next thing is equity, which is the value attributed to the business or the business's book value. So this is very important because it's what you own in the business. Remember when I said that the balance sheet is an aggregate or accumulation of things that happen in your business from the beginning when you first started your business? So that's where retained earnings comes into play. So retained earnings consists of all the profits or losses that your business has incurred every single year, right? And it keeps adding. So if you had a profit, the retained earnings will go up. So let's say I just started my business. This is year 1, and I had a profit of $10,000. So on my balance sheet, my retained earnings, what it's like literally called retained earnings, it's going to be $10,000. But then now it's year 2 of me running my business, and I incurred a loss. Like I didn't have a net profit. I had a net loss at the end of the year of $5,000. Now that's going to bring my retained earnings to $5,000. It was $10,000 before year 1, but now I had a loss in year 2 of $5,000. It brings my retained earnings down to $5,000 because it's taking that 10 minus that 5. So I'm back down at 5,000. Then in year 3, if I had a profit, it would bring it up again, bring it down, and so on and so forth. So obviously it's more advantageous to me as an owner if I keep making a profit because my retained earnings will keep increasing, right? And that's good. That means as a business owner, I'm making a good return on my money and a good return on my time for having a business, right? And return on equity, this is an investment, right, that I'm making as a business owner of my time, of my funds, right? And so I want to have a good return on my investment in my business. So usually we shoot for 50%. And that's based off of how much profits I'm going to bring in, right? If I'm not bringing in any profits, I'm not going to have any returns, like a good return on investment. And so when you go and sell your company or something like that, they're going to look, buyers are going to look at the equity account and see how well you did with the business overall. Or if you go to a bank and you apply for a loan or a line of credit, they're going to look at your equity section because they want to make sure that you're getting a good return on the business and that you have enough skin in the game. So if I didn't make any profits or I didn't contribute anything to my business, then a bank is going to look at my business like, okay, they don't really have anything to lose here. You know what I mean? So they will be less likely to qualify you for a loan. Then you have owner's draws, which affects equity overall. Owner's draws is when I take money out of the business for me. So maybe I go to an ATM machine, I withdraw funds, or I transfer money from the business bank account to my personal account, or I made a check out to my name from the business to me. Or if, let's say I went to Macy's and I purchased a purse, which I know Joe wouldn't be too happy about if I did that all the time with our business bank account. But let's say I did that. That means I'm taking money out of the bank of my business for personal reasons. So all of those reasons, they're going to be labeled as owner's draws, or all of those transactions are going to be labeled as owner's draws. And what owner draws does to your equity, it decreases your equity. So remember, so if you have a loss, it decreases your equity. If you take money out of your business, it decreases your equity. Owner's contribution. So this is the opposite. Let's say I have a personal savings and I take $5,000 from my personal savings and I contribute it to the business because I'm funding the business in some way or another, then that's going to increase my equity. And like I said, profits increase the equity as well. Okay, perfect. So this next slide, shows the expanded version of the balance sheet, which is what we were looking at before was like a condensed version. So this is an expanded version. And we can get into exactly remember when we spoke about current assets, so you see bank accounts, right? You see savings. So that's the current. Some examples of like some machinery and equipment, bobcat, trailer, mowers, all of that, vehicles. And this is what I was talking to you about before. I forget who asked. Oh, Darren. Darren asked about would the equipment that's fully depreciated still be on the books? It would be. It would, like, let's say if this was fully depreciated, it would still stay here, but the 30,000 that would wash it out would be here. You see this negative amount? So that minus that would like net it out, if that makes sense, to zero, would wash it out. And yeah, moving over to the liabilities. So some examples of some current liabilities, like I said, kind of your credit card or payroll. And then, like I said, you guys have, some loans, Ford, Sheffield, all of that. And then here's what your equity accounts may look like.
And Carla, as for cash versus accrual when it comes to the balance sheet, you mind going over a little bit of that?
Yeah, so for cash basis, we're talking about money coming in and money coming out of your account. So you may not have like payroll liabilities if you're on a cash basis, because again, you're not taking into account for future things that you have not paid. So again, because the payroll that comes out of your account, that's what gets posted on the profit and loss, and that's it. So you wouldn't have like payroll liabilities or accounts payable or accounts receivable. You wouldn't have, because on accrual basis, you're counting the cash that you may not receive yet, and that's accounts receivable, like the money that you need to collect from your clients. But since you're on a cash basis, the accounts receivable doesn't show on your balance sheet because, again, the money that came in is what comes in and what comes out. So those are the major differences, is AR and AP, along with some other stuff. So overall, though, the accrual basis balance sheet gives you more insight into your business, though. Like if you're able to track your AR and accounts payable balance, it's going to give you a better look at your business, because you can then track, okay, what money am I expected to collect, which is your accounts receivable, and what money am I expecting to be paid out to other vendors, which is your accounts payable. So that's why it gives you a better vision or financial visibility about your business, rather than just having it cash. Not that cash is not good. You still get a good view, but you just get a better view with accrual.
And Carla, what does the negative owner equity reflect here? Does it mean that the owner's paying into the business?
Yeah.
Question from Raj.
Yeah. So the negative owner equity could be some different things but most likely what it means here is that they're taking money out of the business to pay themselves, like owner draw as well. So instead of them putting money in the business, they're taking more money out. And or it could also mean that in the past they've had losses in their business. Instead of making a net income, like we see this positive number, it could mean that they've made like more losses in the past, which would be negative, and so their equity would be negative. Here, sorry, I got a little crazy with this.
Awesome. And we're going to dive into other examples of some balance sheets, and specifically within some of the ratios. So as Carla goes through this example here, just try to take note of some of the different ratios and equations. And if you don't really remember the exact equations exactly, we can definitely send those over to you. But just as long as you kind of understand the overarching idea behind how we approach some of this analysis. So,
yeah, Joe, do you mind putting our videos on the bottom so I can just start? Thanks. Okay, so one of the things that we can do, that you can do to interpret your balance sheet, is comparing one period to the other period, right? So in this example, I'm looking at a balance sheet as of March 31st, 2021, and I'm comparing it to my balance sheet as of March 2022. So you want to look at the same period when you're comparing. So you can compare 2024 January through March 2024 to January to March 2025. That's something that you can do right now, because the first 3 months of the year are finished. And so that would be a good thing to do. So in comparing some of these things, what you want to do is compare some of the ratios within your balance sheet. So starting off over here on the right hand side, you can see the current asset ratio. So let me see here. So the current ratio. So the current ratio is your current assets divided by your current liabilities. So under each of these ratios, you can see the formula. You guys can write that down and stuff. But you can see on the balance sheet where you get those numbers. So let me just run through this example with you real quick. So current assets is over here, you see 90,500 divided by your current liabilities, which you see over here, 63,567. So that's what you would need on QuickBooks or Xero, whatever accounting system you're needing, is those two line items on the balance sheet for each year. And it's really simple. It's just, division. But if we take those numbers and we compare the 2 years, we can see that in 2022, I did better with my current ratio. And what does that all mean, right? What does that all mean? Current assets, if we think about it, it's the AR and the cash that I have on hand divided by what I owe to others in the current period, right? So what does that tell me? That tells me that I was able to pay my current liabilities more efficiently in 2022 than I was able to pay it in 2021. That means I had more resources in the company to cover my debt, like my current debt, like sales tax, payroll, some of those things. So you see how much insight the balance sheet can show you. It can show you like if you're doing better with cash flow, which for this company, they're doing way better in 2022. And for this ratio, you want to be above 1. Okay, anything above 1 is good. If you're below 1, that means that you're having a little bit of a harder time meeting your debt obligations to, you know, to cover those. So then we have debt to equity. Okay, I'm not going to go over every formula and where you get the numbers. I think, you know, we covered that in the first one. So you can see that the company did worse with that. That means that I had more liabilities than I had equity. So I owed more to others in my company than I own in the company. So remember when I was talking about like the bank, they want you to have some skin in the game, right? Like, because then that means that you have something to lose. Here it's saying that like my liabilities are inching upward more than what I own in the business. So I don't want to be in that position because I want to always have more equity than like what I owe to others, you know, so because then that means my company has more value. Asset newness. So this is something that this is a ratio that I really like using with different businesses, because then I can let them know if they're purchasing trucks, machinery and equipment too fast, or do they have a lot of like old junk that they need to replace and upgrade? And we get that question all the time. It's like, okay, Carla, when can I buy a new truck? I'm looking to add on a new crew, or I'm looking to add on this different service line, and this equipment's always breaking down on me. So that's a question that we get often. And one of the ratios that we look at is asset newness. So what this is telling me is that when this number is lower on the scale, so like let's say 0.3, if it was 0.3, that means I have a lot of old junk that I need to replace, like some mowers, right? Maybe. And then I can look at probably repairs and maintenance and probably see that that's probably high on my profit and loss, you know? But the closer that this gets to number 1, that means that I have a lot of new equipment and stuff. So if I see that a company has like 0.9 on this and they're asking me about purchasing a lot of new assets, I would take a double look at this, because I'll say, well, you just purchased a lot of like new equipment and machinery. So it's good to gauge where they're at. Then the next one, return on assets. So in the landscaping industry, the business model is that you're using machinery, equipment, mowers, trucks to run your business and to help you make those beautiful landscape projects, right? It's just part of the business model. Just how like accounting services, my business model is, you know, I don't have any of the fancy equipment or anything like that, but my business model is having great landscaping accountants. My model is having great people. Like that's my biggest asset. But for landscaping is, yes, you have the labor component, but you also have this very important thing, which is purchasing the tools that you need to create the services, right? So that's why it becomes very important to analyze how well those vehicles, machinery, and equipment are performing out in the field. Like your employees, right? You want to know, are my employees getting trained enough? Are my employees efficient enough? Am I hiring the right employees? Just how you think about it in that way, you need to think about your equipment in that way, which may sound silly, but it's super important in this industry to think about it in that way. So return on assets is going to help you determine how well your machinery and equipment vehicles are performing. So yeah, by looking at your profit and dividing it by your total assets. So the closer to 1, the higher the number here, the better. So if I see in 2021, it wasn't too good. It was at 0.36, but then it went up 0.42. So that means I'm performing the jobs more efficiently, better with the assets that I have, again, machinery, equipment, this year than I did last year. Awesome. So then that could maybe give me a level of comfort, like, yeah, buying, maybe it looks like this company might have purchased some new equipment, and now I'm seeing, okay, the returns on that. Like I made a good decision, right?
Yeah. And a way to look at that too is, let's say you have $1 million worth of assets. In 2021, this company was doing $360,000 in net profit based on those $1 million in assets. Whereas in 2022, they were able to increase that to $420,000.
Somebody said, just to confirm, equipment that you lease and not own should not be considered an asset. Right. Sorry, that was like a double negative. Right. If you lease it, it's not an asset. It's just an expense on your profit and loss because you don't own it. All right. Then moving on, return on equity. I mentioned this before. Like, you work hard every day in your business. You want to make sure that you're making a good return on your money, a good return on your investment. So that's the return on equity. And obviously, the higher that number is, the better return that you're getting. And if you plan to sell your business one day, which is probably most of your guys' goal, then keeping an eye on that is really good, because you want the higher that number is, the better probably multiple that you'll receive for the sale of your business. Asset turnover. So, okay, this is another thing. Remember, you want to make sure that the machinery and equipment, trucks that you purchase is performing well in the field, right? How do you measure that? Asset turnover. So this ratio, what it's telling me is, for the amount of sales that I'm generating this year or this period, are my assets producing enough, right? Producing well enough in comparison to the sales, right? So 2.4 in 2021, and now that went up to 2.7, which is worse, okay? So we want to make sure that we keep track of that, because we can also measure capacity on that as well. So if somebody asks me, hey, can I purchase another equipment or add on, whatever it is, I want to make sure that I'm giving you the best advice. Like, no, maybe we need to hold on and add more sales to the business before we add on more equipment purchases, because it looks like for the sales that you're making right now, the equipment is just not performing as well as we need to. And sometimes I think that has to do with, like, there may be like a certain big like asset that you have. Maybe it's a skid loader and you're not getting enough projects where you're utilizing the skid loader. So maybe the solution is, like, let's market for more of those projects so we get in more sales, so that this number and this ratio is better, right? So that's what that tells me. Now the next ratio is debt ratio. So this helps me determine, like, how am I doing with debt? And I get that question a lot, like, am I debt heavy? Should I stop taking out loans? Or how does that look like? Because sometimes it's like people are scared of debt, and that's okay. But sometimes in this industry, debt is kind of like, I don't want to say inevitable, but it's part of the normal business model. You know why? Because you need a lot of assets, trucks, machinery, and equipment to run this business. And a lot of that is funded or financed by debt. And so it's a normal part of running a landscape business. And you want to make sure that you're in line with what the industry is doing. And so here, when you get close to that one mark, you're doing worse, but when you're lower, that means you're doing better. So I went from 0.53 to 0.47. I'm managing my debt better.
Awesome. So now that we kind of have some of the definitions down, we've kind of seen some of the ratios here. We're going to dive into some more examples of some of the different categories that we would break down the balance sheet with through looking at some of the ratios and really trying to see the financial health of each company as well. So we're going to go through some different scenarios here. And the first company is an install-based company that does about $840,000 in yearly sales. So that's what we're going to start with.
An install company.
Yeah. Okay. So, and we went through some of this if you were on the previous webinar going over the profit and loss statement, but there are some additional categories here. So you have the profitability section, you have the efficiency, which is more related to the labor, a lot of items within the P&L, liquidity, right? So Carla had mentioned things like the current ratio, right, which shows more of that shorter term cash flow insights, and then leverage, right? So utilizing debt within the company and then asset usage as well. So these are different categories that we would analyze, and even within some of the reporting within Cycle CPA as well.
And you just asked, debt is the same as total liability. Yes.
So yeah, within this company, I mean, there's a couple different things to kind of look at, I think, starting even when it comes to return on fixed assets. So as Carl mentioned, you're looking at, okay, how much net profits being generated based on the equipment and trucks that the company has. This company's actually decreased from the previous year. So they're around 14%, whereas the industry median is typically close to around 30% or so.
But equity went, return on equity also went down. That's the return that the business owner is making on the business. So then that tells me that the profitability in 2024 of the business went down overall. Not that they purchased more assets. Or it could be that, but it's more leaning towards that the net profit went down. So the efficiency of the assets for that year went down as well, if that makes sense.
Yeah, so we looked at the return on fixed assets, which decreased, right? So that can show some improvements. So okay, why are we not generating enough profits? So return on fixed assets typically close to around 30% for install-based companies. I'm sorry, that looks like it.
I know. I can't write with this one. I can't write like numbers or letters.
Yeah, and then even return on equity, that's typically close to around 40%, right? So this company, you could see, I would say that these two areas, they definitely have room to improve. Of course, even when it comes to net income, as we mentioned in the webinar, when it comes to net profits, typically we like to shoot for around 15 to 20% for that.
Well, you could see they went from 27 to 8 there. So that's why those two went down.
And then one of the other things was the fixed asset turnover ratio. So if you remember, that was one of the items that Carla had covered, how much revenue is being generated based on the equipment and trucks that the company has. And as Carl mentioned too, it can kind of give you that ability to look at the capacity. So if you have a set amount of equipment and trucks within the company and you're only generating $2 million of sales versus the industry median or the trend shows that you should be generating 3, why is that, right? Is it because you just decided to purchase a little bit too much ahead of time, or, so this, although the trend increased slightly or barely
Not good.
from the previous year. We still like to see closer to around 6 for this ratio. So again, that's just simply your sales divided by your fixed assets.
I know, like, just to relate this to an analogy, it's almost like if you hired like 5 direct laborers ahead of time, but you don't have the sales to give them work. Like they were just sitting around not doing anything.
Yeah.
The same thing here. This is what it's telling us for this company. Like the machinery, equipment, trucks were not being utilized for the amount of sales that they were bringing in. So another good indicator to let you know, whether you should make those moves.
Yeah.
But yeah, we can move on to the next one.
All right. So this company was a $2 million company that does more of the recurring maintenance type of services. I can make it a little bigger here. There we go.
So right off the bat, you can see return on fixed assets, excellent, 91%. Return on equity, excellent, 176%. So this company knocked it out of the park when it comes to their returns. Perfect. And then if you scroll down to leverage, so debt, that went up, but it's still okay. Not too bad. Debt went up. I'm sorry. Debt didn't go up. The equity to assets went up. So equity to assets is the amount of they funded some assets, but they used the cash that was already in the business. They didn't use loans. So that's what that means. All right. So they didn't take on any like additional loans. So that's good because you see the liabilities underneath it, liabilities to assets, that went down. Because as they purchased more machinery and equipment and trucks for that year, instead of taking out loans, they utilize the cash that was already there in the business. So that's good. That's why we see that in the green. And then obviously the liabilities to equity is good.
Yeah, and liabilities to equity, this company is definitely, although it's trending in the right direction, it's still not really in the ideal position. Really you want to be, much, much lower than this, below 1. But we also see on the install companies about typically double what the maintenance companies when we look back at the 2024 data. So just some things to kind of consider. But overall, this company has great trends with a lot of the different balance sheet metrics. But I would say the liabilities to equity, probably the biggest improvements need to be made there. Which, again, even when it comes to some of the short-term cash flow within the liquidity, there is some area to improve there within the current ratio as well, which we're going to dive into here. Yeah. So this next company is a $3.8 million install company.
Yeah, I guess just looking at the return on their fixed assets, so 37%, doing well, above the industry average there. So that's really good. Even though it dropped from the prior year, it's still really good. I think maybe in the prior year, the profit was a little bit higher. So that's why it was, the return on things was higher, but it was still good where it stands. and the return on equity. So the return on investment for the business owner, even though it went down, 124% is really good. And then we go down to the leverage section. So equity to assets, that went down, but by a really small percentage. And 25% is good. Liability to assets, still sitting in the right directions. Liability to equity, I'm high there. It has, and that's really what we see, what the normal is in the landscape industry. Really, that the liabilities are much higher than the equity, and I think it's just because like a lot of loans are used to finance the trucks and machinery and equipment. So until you pay those loans down, this number is always going to be.
Well, for this benchmark category, it is closer to around 0.56. So this company is really high for liabilities to
right.
So definitely some room to improve there.
That's what I would do next, because it looks like they have. I would say they would have. They would need to work on paying down some of those liabilities for sure.
Yeah. So that's going to be high. So working on a strategy there to pay down some of the debt. And then also they have some opportunity here as well, where the benchmark here, like I said, is typically around 6 when you do the sales divided by the fixed assets. So they have a little bit more capacity to be able to generate some top line sales based on the equipment and trucks.
Yeah.
Another key thing here as well is the current ratio is almost 1-to-1, which we do want to see this to be closer to around where the industry median is around a 1.9 to 1 ratio, right? So you have more cash, accounts receivable, current assets, right, versus some of your current liabilities like accounts payable and other more of those short-term liabilities. So, these are items to, again, liquidity, meaning some of that shorter-term cash flow. Definitely some opportunities there as well. And then we'll take a look at, so this is a $2.1 million install company as well.
I mean, they're just knocking it out of the park with their returns on fixed assets, 88, return on equity, 208%. I think that, so equity to assets, 31, it's good.
Liabilities to equity, they definitely have some room to improve. So
right.
Some of these companies similar.
I think
overarching things that they might need to work on.
Paying down some of that debt,
which can also impact. Again, like I said in the previous company, even some of the shorter term cash flow, I could see some improvements there as well.
But I'm gonna tell you something. The asset usage. So if you scroll down, the fixed asset turnover ratio is really high, and they're doing really good. That means like the machinery, equipment, trucks that they have for the amount of sales, they're operating very efficiently, with the assets that they have and the revenue that they're generating. So that's really good. It seems like the assets are fairly new, almost at 0.8. So whatever purchases they made recently has been paying off,
And profitability is low. So maybe there's another reason, maybe they have the right equipment, right? And they're obviously using it in the right way to generate the top line sales.
Right.
But maybe there's other reasons of within the company outside of the equipment, right? That maybe dive into the P&L or pricing, right? Where their net income is actually not where you really want it to be. But yeah, no, that is pretty impressive. They're definitely generating a good amount of revenue based on that. Again, the current ratio, some opportunity there as well when it comes to coming up with those short-term cash flow.
Awesome stuff. And
then some opportunity here to improve as well.
Yeah. So really utilizing these reports to help, the business owners who have those questions and monitoring their health. It's like, okay, well, what area do we need to focus in on? Is it paying down debt? I mean, this company, if they told me, hey, Carla, I want to increase my marketing spend and really bring in more marketing and sales and maybe watch my margins and increase the net profit, I would say go for it, because I think they're doing such a great job with managing their assets that why not, right? They have that in place. And then, we can make a plan to pay off their debt, I think, right? So I think that's where the opportunity area lies. So I think different companies have different opportunity areas to improve on, but you can take like one thing that they're really good at, which is using their machinery and equipment and stuff efficiently to help them pay down debt, right? So maybe an area they're not doing so well at. Whereas I think it was which one was it? The first company you analyzed, Joe, where, their liabilities to equity was very low. And so they have less of that fixed cost burden of each month of like having to pay these loans out if they're a seasonal business, which is good. So then that's their major, that's something that they do very well in. So I think, utilizing these numbers to make good decisions and utilizing it in an efficient way. I think that's where we want to help everybody. And so,
and this is that first company that we had analyzed. So what Carl was basically saying was, because their liabilities are low here, what that also correlates to is, having a healthier short-term cash flow in regard to your current ratio.
Right.
So even them not generating high profitability, they're still not in too much of a risky position because
right.
their debt is relatively low.
Exactly.
I think when it comes to your net profit, it really puts you also in a good driver's seat to be able to make certain changes and even grow within your company. This is why even when companies go to acquire other companies, you want a higher profit, right? Especially if you know that you're putting a lot of debt on the company, because that's going to impact your cash flow. So just looking at these different components.
Awesome stuff. Does anybody have any other questions? Somebody said, what is the potential of using cash basis? So I think when you're determining whether you're going to use accrual or cash, I think it's thinking about like, how does your business operate? If I'm in my first year of business and I don't have any credit cards, or I'm sorry, not credit cards. If I don't have any like trade credit set up with SiteOne or any vendors, and I don't have payroll yet, and I don't have AR yet because all of my clients are new, and maybe I just charge them each month for the service. I don't really have any outstanding balances. Then why would I use accrual? It's not going to make a difference, because there's no timing differences between, what people owe me and what I owe to people. There's no timing differences. I go to the store, I pay right there. People pay me right there when I do the services. That's pretty much what it looks like for the first few years of you, especially if you're a solopreneur. So it doesn't make any sense accrual. But when you're in business for a few years, or if your business does operate like that right off the bat, if I am using trade credit with SiteOne, I have established trade credit with other people. I have payroll on the books. I give people terms. So my clients don't pay me when I go to their house. They pay me 30 days later, right? That means I have accounts receivable balances. That is my business model. So that's when it makes sense for me to look at my financials accrual basis. But I think also having a pulse on your cash and cash basis financials are always super important as well. Yes, this is recorded. Somebody said, oh, I like this question. Somebody said, how should I account for sweat equity if I don't take a salary for a period? That's a good one. So I guess I'm going to use the example of when you're first starting out your business and you don't pay yourself, you're just taking in any job, go in there doing a hard day's work, right? Day and night for a year. You didn't get paid anything. What really happens is the way that you account for that is remember for the year you're going to have a profit. So for year one, I'm going to have a profit, and that profit is going to go on my balance sheet into equity. So $10,000 minus whatever I may have taken out for, draws or something like that. Even if you weren't on payroll, I'm sure that you probably took some money out of the business just to cover personal costs or something like that. Then that's the sweat equity part that you're talking about. If you didn't take any money out from the business and you just worked really hard, then there should be, profits, and then that should be on your balance sheet. Awesome stuff. All right. Well, this was.
Oh, I'm sorry. I was muted. I'm going to send all 3 parts of this webinar series, all the recordings, after the last one on Wednesday, which is the last part, which is the cash flow statement. So we're going to go through that. Looking forward to that. Cash flow is a huge thing, in a seasonal company and just within the green industry in general. So looking forward to diving into that. I hope everyone has a great weekend.
Yeah, have a nice weekend. Thank you. Bye.